Chapter 3. The Return of Feudalism, Part 2 of 2. The Racial Architecture of Neo-Feudalism. The mechanisms described above, corporate personhood, limited liability, immortal entities, and layered shells, are the general architecture of modern feudalism. But America has a specific architecture as well, and it is racial. Slavery was the original American feudalism. It was labor extraction without compensation, wealth accumulation beyond public scrutiny, hereditary power maintained by law. The slaveholder controlled people as assets, extracted their labor, and passed the accumulated wealth to his heirs. This was not a metaphor for feudalism. It was feudalism, stripped of even the feudal lord's nominal obligations to his serfs. Emancipation ended legal ownership of human beings. It did not end the extraction. Black codes criminalized black autonomy. Sharecropping replaced slavery with debt peonage. Convict leasing sold imprisoned black men's labor to the same plantations they had worked as slaves. Each new system preserved the feudal relationship under a different legal name. The 20th century refined the mechanism. When the federal government created the modern middle class through the New Deal, the GI Bill, and the Federal Housing Administration mortgage system, it did so on racially exclusive terms. Federal Housing Administration underwriting manuals explicitly designated black neighborhoods as ineligible for federally backed mortgages. The practice, known as redlining, locked black families out of home ownership during the decades when home values were rising fastest. GI Bill benefits were administered by state agencies that routinely denied black veterans access to subsidized education and housing, particularly in the South. Discriminatory lending practices continued long after formal redlining ended, through steering, predatory subprime targeting, and appraisal bias. The results are measurable. As of 2022, the median white household controls approximately $284,310 in wealth. The median black household controls $44,100. The median Hispanic household controls $62,120. Nearly 20% of black households have zero or negative net worth. Black household wealth is approximately 50% concentrated in home equity, compared to roughly 20% for white households, meaning black families are disproportionately dependent on a single asset class they were systematically excluded from acquiring. These gaps are the direct products of specific policy decisions, many within living memory, that built wealth for white families while extracting from or excluding black and Latino families. The feudal pattern is unmistakable. One class accumulates across generations, while another labors without accumulating. The current tax system compounds the disparity. It taxes income, which these communities earn through labor, while exempting wealth, which they were systematically prevented from building. Capital gains preferences deliver 92% of their benefits to white families. The stepped-up basis erases appreciation at death, but only for those who have assets that appreciate. The mortgage interest deduction subsidizes home ownership, but primarily for those who could get mortgages in the first place. Payroll taxes, the most regressive element of the federal tax system, fall hardest on low-wage service workers who are disproportionately black and Hispanic. The feudal structure has a racial architecture. Any reform that ignores it is incomplete. Chapter 15 examines specifically how shifting from income to wealth taxation changes the equation for these communities. Feudalism in modern dress. The racial architecture above is the sharpest expression of the feudal pattern, not a separate one. Today's largest fortunes sit inside the same four-feature architecture. They extract from the economy while contributing less than their proportional share. They benefit from the infrastructure of civilization while paying effective tax rates that are, by the numbers, lower than what a medieval peasant owed. Under the feudal bargain, a peasant owed roughly a tenth of their harvest to the estate and a tenth to the church, a combined nominal rate vastly higher than what the ultra-wealthy pay on wealth growth today. Wealth perpetuates untaxed. The stepped-up basis rule, described in Chapter 2, eliminates capital gains at death. If you buy stock for $1 million and it grows to $100 million, you owe no tax until you sell. If you never sell, you never pay. When you die, your heirs inherit the stock, with the gains erased. Dynasty trusts compound this advantage. Properly structured, wealth can pass from generation to generation without ever triggering estate taxes. The Walton family, heirs to the Walmart fortune, are worth more than $500 billion as of 2025, according to Bloomberg's Richest Families ranking. Through dynasty trusts and careful estate planning, they have structured their holdings to minimize estate taxes on virtually all of it. Medieval estates passed intact to heirs. Modern dynasty trusts achieve the same continuity and do so without the inheritance taxes that once provided at least some check on dynastic accumulation. Controllers benefit without contributing proportionally. The ultra-wealthy use courts to enforce their contracts, police to protect their property, infrastructure to move their goods, and the entire apparatus of civilization to make their wealth meaningful. A stock certificate is just paper without a legal system to enforce ownership rights. Yet, as Chapter 2 documented, they pay effective rates near zero on their wealth growth. For the ultra-wealthy, that is the norm. The social contract is supposed to be reciprocal. You benefit from society, you contribute to society. At the top of the current distribution, the relationship has become lopsided. Political influence operates through obscured channels. Dark money floods elections. Lobbying armies shape legislation. Regulatory agencies are captured by the industries they are supposed to regulate. The rules are written by those they are supposed to constrain. This is not corruption in the crude sense of briefcases full of cash. It is structural capture, and it follows naturally from the incentives. A tax system built on income rather than wealth creates, by design, a class with the concentrated resources to influence the rule-making process. You do not need a conspiracy theory. You just need a system where one class accumulates without visibility. The wealthy fund think tanks that produce research supporting their interests. They endow university chairs that train the next generation of policymakers. They own media outlets that shape public opinion. They hire the lawyers who become judges and the staffers who become regulators. The rules that maintain their invisibility are the rules they are best positioned to protect. A class operates beyond the reach of the rules. When corporations commit fraud, executives pay civil fines, often covered by insurance or the corporation itself. When wealthy individuals evade taxes, they negotiate settlements. When they cause harm, they write checks. A poor person who steals $100 goes to jail. A wealthy person who steals $100 million pays a fine and admits no wrongdoing. You cannot regulate what you cannot see. You cannot tax what you cannot measure. A system that taxes labor but not wealth creates, by design, a class whose economic life takes place entirely off the books. The enforcement failures are a downstream symptom. The system was never built to make these people visible. The titles are different. The legal vocabulary is different. A class operates beyond the sight of the system that binds everyone else. The architecture of invisibility. The defining feature of neo-feudalism is not that the powerful escape punishment. It is that the powerful escape sight. What looks like a gap in justice is actually a gap in information. The system cannot hold anyone responsible because the system cannot see anyone. The BP Deepwater Horizon disaster killed 11 workers and ultimately cost BP more than $65 billion in cleanup, settlements, and fines. The corporation paid fines, but who made the decisions that led to the disaster? The corporate structure diffuses control across boards, committees, subsidiaries, and contractors until the human being who chose to cut costs on safety disappears into the fog. Wells Fargo employees created millions of fake accounts to meet sales quotas. The fraud was systematic and directed from above. The corporation paid billions in fines, ultimately borne by shareholders, many of them pension funds and ordinary investors. The executives who created the pressure and ignored the warnings. The corporate structure was not designed to make them visible. It was designed to make them disappear. The Sackler case follows the same arc. The system fails to identify long before it fails to punish. Corporate boards, bylaws, committees, and internal reviews create layers of abstraction between the human controller and the public. We have conducted an internal investigation and taken appropriate action. What action? Against whom? The public rarely learns. A duty of control, the principle that whoever can direct an asset is responsible for it, would collapse this labyrinth. It requires a system built to track control in the first place. No amount of political will alone fixes this. The fog is a structural consequence of how the system was built. Every layer of corporate abstraction, every shell entity, every trust with a nominee director exists because our tax code never required wealth to be declared, tracked, or attributed to natural persons. A tax system built on wages and not on wealth produces exactly the opacity its architecture permits. The stakes. Here is what is at risk. A republic requires rough equality of power among citizens. When wealth concentrates, political power concentrates with it. The wealthy fund campaigns, hire lobbyists, and shape the information environment. Their preferences become policy. Everyone else's preferences become irrelevant. Every republic in history that tolerated oligarchy eventually fell. Rome's republic gave way to empire as wealth concentrated in fewer hands. The Italian city-states were absorbed by monarchies. The arc is consistent. Concentrated wealth corrupts democratic institutions until they become hollow shells, maintaining the forms of self-government while the substance belongs to the few. We are on this trajectory. Wealth inequality has reached levels not seen since the Gilded Age. The top 1% now controls more wealth than the entire middle class. Political scientists have documented that policy outcomes correlate with the preferences of the wealthy and show no correlation with the preferences of average citizens. The current trajectory leads towards permanent aristocracy. Technology accelerates concentration. Network effects create winner-take-all markets. Automation displaces workers while enriching owners. Artificial intelligence promises to concentrate power further. The window for meaningful reform narrows with each passing year. Working-class conservatives and progressives share this interest. The division is not between Democrats and Republicans, but between those who play by the rules and those who write them. Between citizens whose tax liability is calculated for them and fortunes whose liability is negotiated. Between those whose economic lives are visible and those who operate in darkness. Visibility is paramount for the long-term stability of a republic. The founders of the American experiment wrote the Constitution specifically to prevent this kind of power asymmetry. This is an excerpt from The Last Tax by Dan Schaefer, available now in paperback, hardcover, ebook, and audiobook. Links are in the description. Subscribe for more as they become available.